This is going to be the first webinar of a webinar series that we're going to be doing specifically for business owners and incorporated professionals, medical professionals, lawyers, and everything kind of in between. You find oftentimes it's a lot of the similar there's a lot of similarities when it comes to finances regarding these. So today's going to be the first one, and it's going to be covering a lot of the macro strategies, specifically today around investing in stocks and real estate. So I know this is a big question that for a lot of people it comes up quite often, and we just wanted to do this webinar series to take advantage of the work from home and kind of give you a quick way to get the information for you. So with that being said, I want to respect everyone's time. Our goal is to be done by 11:30, leaving a little bit of time for questions if they arise throughout the presentation. Just feel free to pop them in the chat. And then I'm hoping to leave a little bit of time at the end to answer those questions. If we don't have enough time, I'll be sure to circle back to you guys privately and just kind of get back to it. And if it's a common question, I'll send it out to everyone on the mailing list. And if you have to jump off early, no problem. I will be sending out the recording to you guys after today's presentation. So thank you. And just a quick disclaimer, these are just broad suggestions. So not all these may fit your specific situation. So please reach out to your tax planner and advisor to see what makes the most sense for you. And I'll be letting in some guests as they pop up. So as I said, if you have to jump off, feel free, no problem. And if you have any questions, just pop it in the chat and we will get to them as we go on. And also a quick thing is you have full control over your display of attendees. So if you want to minimize it, my camera as well, if you want to minimize it, feel free. That's not a problem. Okay, so a little bit about myself. So portfolio planning, we were founded to be a fully independent planning firm. Essentially, in a nutshell, what that means is that there is no specific interest of any one company over another. We are compensated the same. We give the same advice regardless who you go with. The only thing that matters for us is that you, as our clients, are put in the best position to be successful, because ultimately that's the most important thing. We are licensed in BC and Alberta, and really we specialize in helping business owners and medical professionals increasing their net worth, protecting their business income, maximizing their take home, and then planning an exit strategy when that time comes. And our mantra has always been and will always be planning with integrity. It's all about the long term. We're not transactional, we're very relationship based. And myself, a little bit about myself besides work, I love hanging out with my dog. I have a golden retriever, and I love sports, specifically basketball. I'm a huge LeBron fan, so if you want to jump off the call based off that, feel free. But I am a huge LeBron James fan. So by proxy, I'm a Cavaliers fan. I was a Miami fan, and currently I'm a Lakers fan. And we have the pleasure of having a guest speaker with us today. So Ryan Sahota is also on the call. My goal in person every time me and Ryan have a joint meeting is I try and make him get uncomfortable because, when I compliment Ryan too much, he starts making weird eye contact. He gets nervous, starts blushing. And if you ever see a brown guy blush, it's quite a sight. So Ryan is on the call. He is a award-winning, very well-respected accountant that we do a lot of joint work with, primarily in the business owner and medical professional field. We've done a large amount of cases together, and he brings a lot of expertise and real-world experience to our clients. So Ryan is on the call, and he will be speaking to answer some questions because I know there's going to be a lot of tax-related questions, and what better person to answer those than a professional. So Ryan, if you do want to unmute and say a couple of things, feel free.
Yeah, no, I appreciate it, Vishal. Thank you, everybody, for attending the meeting today on a Saturday. Really appreciate that. I do apologize. I've got the blinds closed, but the lights still kind of hit my face in weird directions, so I apologize. That looks strange. Also like Vishal, I am a Lakers fan. Since pre-Kobe, and no, I'm not a LeBron fan. So you guys can stay on the call if that works for you. But it's been great being here on the call with Vishal. I know he's got a great lineup for you guys today on Saturday. A lot of great advice, and it's been a pleasure working with him. Him and his team do a great job on a lot of our clients in regards to structuring for tax efficiency, taking a look at different investments, especially with a lot of the new changes that have come up combined over the last 3 and 4 years. and also just taking a look at, what influence COVID's had on a lot of our clients' businesses, and then being able to be proactive in terms of liquidity, looking at triggering events and risk management. So, yeah, you guys are in for a treat today. Thanks, Sean.
Awesome. And Ryan, that's the life in the hills when your only complaint is I got too much sun in my face. So not a bad problem. But yes, thank you guys for joining on the Saturday. Okay, so moving on, when it comes to building a comprehensive financial plan, oftentimes, people ask the question, hey, which asset class is better than the rest? It shouldn't be one or the other. It should be a fully comprehensive blended strategy for everything that applies to you. The starting point always should be, especially for you guys as business owners and medical professionals and business professionals, taxation. It has to be the foundation. Sometimes we have clients, and the spectrum is quite wide, where sometimes they have a bookkeeper, or sometimes they have their uncle or someone that they worked with when they were just starting their profession, and they help with the tax, but it's not tax planning. So we're going to talk about a little bit of what to look for, but taxation planning has to be the foundation of what we start working on, because a common theme that we hear that I'll mention a bunch of times is it's about your take home. And your take home has to be the most profitable one. So you can run a profitable business, but you also have to run your own personal finances as a business as well. Chase high margins, high ROI, and take home the most amount of money and maximize your earning income years. So as I said, when it comes to asset classes, there's not one over the other. Every profession, you can plan for when things are going well, but when things aren't going well, that's where a lot of businesses fail and fall apart, and legacy planning kind of falls off. If you look to the left-hand side here of the planning pyramid, as we say, there's a bunch in there: protection, wealth accumulation, growth and diversification, and speculation. Really where we shine at portfolio planning, and big time with Ryan's help with Pacific Chartered Advisors, is we really shine in the protection and the speculation side of the business. With current tax rules, really these are the biggest opportunities, the lowest hanging fruit, and what can help business owners the most is the protection side of their business and the tax speculation side of the business. It's not tax avoidance, it's tax efficiency. And that's a big one. You may see some memes here and there about, hey, do this, do this, do this. As I said earlier, it may not apply to you. It's about tax efficiency. We want to run everything as efficient as possible and get you to your long-term goals. Our job is to support you guys and get you there as the most efficient way possible. So real estate, we're going to talk about that today. If you look at the speculation category, real estate, we're going to talk about a little bit today. Business interests, tax, I don't like the word shelters, but tax efficiency, we're going to talk about that as well. And then the protection one, we're going to plant some seeds on a couple of those categories, but we're going to be talking about that in a different webinar series. But today is going to be stock market and real estate, active real estate, and also stocks. And my only sales pitch today is going to be, if you guys have any questions, give us a call. That's it. That's the sales pitch. So let's get into it. So this probably looks familiar to you. It might look familiar to you. You have an operating company or opco, and you have a holding company or a holdco. And you have some personal, when it comes to your finances, there's a professional side or a corporate side and a personal side. Everyone has a personal life that they want to fund. So you generate lots of income in your operating company, you transfer what you need, and you pay yourself on the personal side. Could be dividends, could be T4 salary, and then the rest transfer down to your holding company, but it starts swelling up because you're having retained earnings. Or some people just say leftover money, unspent money, extra money, whatever you want to call it. Holding company starts earning a lot of retained earnings, and it's starting to swell up a little bit, and you're starting to hear from your accountant or your colleagues of potential tax issues that could be coming down the road. If there's one thing about the Liberal government, they love that retained earnings. That was a big push of not having trapped money sit there, and we want to start looking at that. So you're in a different set of problems. You have money sitting there. If you have it sit there, you start hearing about all these new tax rules that are starting to stress you out. If you pull your money out of your corporation, you start paying high personal income tax. So you're kind of trapped. And that's where a lot of business owners, that's where a lot of our clients start to feel that, we're trapped. I have all this money, I'm earning, good income, but what's it all for if I can't do anything with it? Common question, but we have solutions for those. The first solution we're going to talk about today is going to be corporate class investments. As I said earlier, it's going to be macro. We're not going to be talking about what specifically you should invest in your corporate class. We're going to talk about the structure instead. And then, we can have a further conversation if you feel that this may fit your needs. But what a corporate class investment is, it's quite complex, but the most important thing to remember, it is allows you to structure your investment to pay less tax efficient. So the less tax you pay, the more you get to take home, which is ultimately the goal is what's your take home profit. And this is done by pooling together investments in a mutual fund, but you're structuring it under a trust. And the most important thing here is that tax isn't triggered until you decide to trigger it or your advisory team, whether that be Ryan, myself, or whoever your existing team is. You can pick and choose when you trigger that tax and when you pay it. This means you can choose it to pay tax in a lower income earning years. As business owners, commonly we see that when it comes to retirement, in between businesses, if you want to get hiatus for a bit, or with 2020, we saw as COVID, a lot of businesses took a hit either for the entirety of the year or for the first couple of quarters. So that's an option as well. If you need to drip out to put some more money in your pockets, that's an option. And in low income earning years, you can trigger the tax. And this really helps when it comes to retirement. We can plan our own clawbacks and other stuff that's there. So it's really, really good. And we're going to get into a slide here. But the important other benefits is that you can pull a lump sum amount of money back into your corporation tax free. And the returns are given as capital gains, whereas 50% of it is taxed as opposed to all of it being taxed as interest income. So let's kind of look what that an example is. So it's a corporate class investment. If you look on the left-hand side, there is a few different types of taxation here. So in the gray is the amount you pay in taxes, and the blue is the amount you get to keep. So interest income, dividend income, capital gains at the bottom left, and then return of capital. If you're like me, I would choose to have the less tax as possible. I don't enjoy funding everybody else. I would rather keep as much money as I can in my pocket. So the less tax I pay, the more I get to keep. Pretty straightforward. So out of those two options, I'm assuming you would probably choose capital gains and return of capital. If I'm wrong, feel free to put in the chat box that you'd like to pay more taxes. That's not a problem. We can structure that for you as well. But if you look at return of capital and capital gains, those are the two most advantageous opportunities for you. So an example on the right hand here, this is a client that Ryan and myself worked with, I believe it was 5 months ago or so. They had $100,000 that they wanted to invest in their holding company to start off and try out the corporate class. So what we did is we structured it around their main income earning years, where after 21 years, they want to have their money back into the corporation. Like, not a problem, let's structure it this way. So how we structure the corporate class investments, built a trust. Ryan's team took care of the structure of it, and we picked the investment opportunities inside of it. And what we did is we started off with $100,000 investment, and the years went on, more and more of that money got dripped back into the corporation. So all that money in the blue, that's return of capital. They're pulling their investment back out of the corporate class, back into the corporation. You already paid tax on that. You don't need to pay tax again. In the meantime, what was happening is the returns on that investment were staying in that tax shelter or that trust. So at the end of 21 years, their full $100,000 came back into the corporation, and that has also earned $100,000 that's sitting there and will continue to grow until we decide to pull that out. So for this client, originally the plan is for retirement, but in a volatile situation, if they need to pull the parachute, pull the plug, and get out and move and sell off their company, they can also start triggering this in earlier years. Very flexible, and that's ultimately one of our main concerns with this client. Is we want to make sure that flexibility is the key. So in this example, you can put your money in, pull your money back out as a return of capital. That's not taxed, and then the capital gains, that's going to be triggered at whatever time makes the most sense, and you pay tax on 50% of your capital gains. And we can talk more about that later. But in that case, it is the most efficient way. And before that, this money was just sitting in their retained earnings in a GIC, not really earning much, and was getting them into some tax problems because they had a lot more capital sitting there. And this is an example of a corporate class. After this, we've done a couple of these, and we just did one a few months ago, anywhere up to $500,000 as a lump sum for an e-commerce client of ours, and kind of everything in between. So this is becoming more and more common for people that want to invest in a corporation, because the question is, again, hey Vishal, I got this trash money that's sitting here, I'm earning lots, but I don't know what to do with it, because if I leave it here, I get taxed a lot. If I take it out, I get taxed a lot. So what can I do? This is the way that you can structure it, build it, and have your income, earning income while you continue to work. So who is this for? As I said earlier, as a business owner, you have a personal side of your finances and you have the corporate side of your finances. This is really for the corporate side. It's successfully incorporated professionals who want to maximize their take home money and continue to build assets in your corporation, tax deferred. So, a good way to think about it is it's kind of like a corporate RRSP. Not exactly, but it's kind of the same thought process of a RRSP in your corporation that you defer the tax and you pay it later on in your when you have less business income or potentially no business income. And this is where, Ryan wakes up in the morning, gets real excited about all the new tax changes that are happening 24/7. The life of an accountant never stops, but a good starting point for everyone is how much tax are you paying? This is very important for you guys to know as business owners is a lot of people sometimes feel that they are paying too much tax, but they have no idea if they are or aren't. A quick thing before this is, it's very important that you are aware of how much you're bleeding on the back end. And if you don't know, make sure you ask these questions to your current team. Or if you don't have a current team or just want a second opinion, I'm going to talk about this at the end of the call, but we are offering a complimentary tax review of your situation. So if you have any questions about the stuff, give us a shout afterwards and we can get in contact. So the first thing is a small business deduction. So this is where everyone wants to be. This is a number that you guys all know. 11% tax as a corporation. 11% tax is kind of what you guys like. However, it's 11% tax on the first $500,000 of active business. Excuse me, active business income. So the trick is, if you can stay at 11%, that's perfect and you're happy. But what happens if you earn too much money? You start to move to the general corporate rate. And so that once you get above that $500,000 limit, you move to the next bracket of 27% tax. An important thing to remember, and a side note here is, we've had this question before of, hey, I have a bunch of different businesses. It's me personally as a shareholder, but I have this business and this partnership and this business and this separate one, and they have 4 or 5 different organization charts. It's irrelevant. However much businesses you have, if you start earning more than that $500,000, you're going to find yourself in some other problems. And it's very important that you are aware of all of your tax situations, everything you're involved in. If you're a shareholder, if you're a partner, make sure that you have that full picture painted for you of what issues can come up down the pipeline. If there's a sale of one of these businesses, what that will mean for you and your tax situation. Because if you have one side of your business that does really well, it can impact all the rest of yours. And altogether, if you're earning more than 500,000, you're gonna start moving up to that 27% bracket, fairly quickly, and it starts to hurt really quickly.
Vishal, is it okay if I just quickly jump in?
Yeah, of course.
Perfect. Sorry, guys. Also, the other thing too is a lot that we notice with a lot of our corporate client groups too is you have to be careful in terms of the amount of assets you're holding in aggregate across your related corporate companies. You'll also lose access to that $500,000 small business deduction if you're holding more than $10 million in aggregate assets across your companies. And it grinds down to zero once you're holding more than $15 million in assets across any companies that be remotely, whether directly or indirectly, trace back as a control group to you. So something that you have to be very, very careful about is whether you have other related persons or other persons who would be identified under the Income Tax Act as being by blood or by marriage related to you, and being very careful about how that small business deduction is actually shared across. So it does get quite complicated. A lot of those changes came in the 2017 federal budget. It's not as simple as just multiplying across anymore to your spouse or somebody else. So a lot of the rules have changed, and this is where Vishal and his team have come up with a great strategy on how to make access to that. Thanks, Vishal.
No, that's perfect. And we've seen it quite commonly is with real estate holdings. Those are huge asset classes that have appreciated tremendously and sometimes quicker than people realize. So exactly what Ryan's saying, if they have multi-million dollars of assets across other different entities, that can sometimes hurt you more and quicker than you even realize. And another thing that happens oftentimes is, especially with new money, you're the first high net worth earner in your family. You want to help a lot of people in your family, and sometimes, as Ryan said, it can be indirectly related to you, and that can sometimes cause problems as well. So, real estate holdings, be very careful with that. New money, we see that a lot where people want to help their family and spouse and friends. So it's very important that you realize how this can hurt you, or how it can impact your business. That's very important to realize because your most important number that you need to know is that 11%. You want to stay within it. It's like that's that tax to know your limit and stay within it, right? That lottery saying. So it resonates with you guys as business owners as well. Another thing to keep in mind is passive investments. held within your corporation, that tax can be anywhere up around 50%. So, and the more important thing is it can reduce your small business deduction limit. So we're going to talk about how this can impact you in a second here. But the more passive investments you have in your corporation, once you pass $50,000 a year in passive earned income held within your corporation, you can really start moving to that 27% bracket a lot quicker. And that's not the space you want to find yourself in.
Yeah, and just to build up on that, guys, while Vishal is transferring over here, it's at a rate of basically every $5 to $1. So for every $1 you earn in your passive investments, okay, above $50,000, you lose $5 access to your small business deduction. Okay, so once you're making close to, I think actually it's $150,000
Yeah.
in passive investment income, you lose complete access to that 11% on the $500,000. And very, very important to note that that includes capital gains. Okay, it's not just dividend or interest or rent income, and also royalty income, and even sometimes franchising fees, depending on how you structure it, can sometimes factor in there as well too. So it's usually very good to get that kind of quarterly planning in place with Vishal. And this is where basically that corporate class comes into play, because it kind of skirts around the issue, and you can actually time your triggering those. Thanks, Vishal.
Yeah, that's exactly it. It's and sometimes we hear like, hey, I'm not in this isn't a problem for me yet. That is the perfect time for you to plan for this. Is you don't want to wait until you get, stabbed right in the heart with a 27% tax rate before you start solving these problems. So the best time to do it is when you're before you get to those problems, so we can plan and skirt around it and never have you in this situation. The other best time is if you are getting hurt by these tax rates, that's also the best time. So regardless, it's a good time to review your tax strategy. And that's an important thing to remember, as Ryan said. So once you're over that 50,000, every $1 that goes past that $50,000 of passive income, that $5 is reduced from your small business deduction limit. So let's kind of see what that looks like. So let me just move this here. So let's go back to Mrs. X. You probably wonder why she's pulling out her hair before, but now you'll understand. So she's a little stressed out pulling her hair out. Same situation as before. She has her operating company. She has a holding company that she's transferred extra money down to, and she's been paying herself a T4 salary so she can have her, Range Rover, classic Range Rover. She can have that and all the other personal assets that she wants. So in her opco, she's earning $650,000, and she has a rental property held within her corporation. That's a great property, earning $60,000 a year. The problem is it's too much passive income. So it's reducing her 11% small business deduction by $50,000. So now by doing nothing and changing nothing and having what you would assume would be a great situation, she's actually be paying an additional $7,500 in tax for doing nothing wrong, just basically holding assets in her corporation and building her corporate net worth. Um, and that's, as we said earlier, when you start getting past that $50,000 of passive income limit, it starts to hurt really, really quickly. And the worst thing is passive income. You don't even notice it. It's like clockwork, you're receiving it. That's why you maybe pay more tax. And if you feel like you're paying more tax, that's a good place to start of what is grinding down your small business limit. So Mrs. X here is paying an extra 7,500 for just having that one rental property held in her corporation. Not an ideal situation. This is where you enter the corporate class investment. It's oftentimes with their clients, it's not more money that they're spending, it's just a reallocation of existing assets. This is a very common situation, and we actually just had this with a client that's in e-commerce business, runs a successful e-commerce business. He had a lot of assets that were just sitting there, some of which were doing not much for him, some of which were hurting him. So what we did is we just reallocated and exited those assets and put them into more tax efficient assets. That in this case is a corporate class investment. So we moved his money that was hurting him tax wise and put it into something that was helping him tax wise. So for this client that we just did, it was, I believe, if I'm not wrong, Ryan, it was about $350,000 I injected into the corporate class investments. And that money was just hurting him before, but now starting to build up that he can use whenever he wants.
Yeah, that's correct.
So what is the difference? This is the main question when it comes to passive versus active. I don't now that I see how much it hurts me, I don't want it to hurt me. So what's the difference versus passive and active? And Ryan kind of touched on some of these before. Some examples of passive investments inside of your company that may be hurting you. It's not limited to, but it can be rent, interest, portfolio dividends, taxable portion of capital gains. That's the stuff that can hurt you on the passive side. And on the active side, It's not limited to, but the taxable capital gains from the sale of a property, use an active business, sale of shares of an active business, tax exempt life insurance, and sometimes it could be a corporate owned critical illness. Put an asterisk by that. We're not going to talk about that today, but um, not everyone can qualify for it. If you're healthy enough, if your assets and your business structure is built well enough, that could be an opportunity for you as well. And we'll talk about that a little bit later. So Canadians love real estate. If you are a Canadian, which I'm assuming you are if you're on this call, I can almost assume that you own real estate, if not multiple properties, and you absolutely love real estate. It's a talking topic at before COVID, before we know we could go to dinners and stuff like that. Real estate's always coming up all the time. Um, the average Canadian has 90% of their assets tied to Canada. That sounds like an astronomical number when you think about the growth opportunities in international investments. However, it's because if you look, 46% is held in real estate. So our real estate is very, very expensive, but it's a great asset class, and a lot of people are invested in it. But oftentimes, it's not held in the most tax efficient way. It doesn't make the most sense. It's not maximized. So more and more families kind of came into wealth through real estate and via real estate, but now they're starting to diversify into better tax planning strategies and international diversification. What many of our clients are doing is setting up joint venture multifamily developments or single family developments inside the corporation, and making sure that that's being held properly for them in the most tax efficient way. And another thing that you can do for active investment is dripping money out of your corporation to the personal side to build a primary residence. And that's the question that comes up often. And if you have time, we can talk a little bit about that at the end. But yeah, let me know when it comes to real estate, if you want to know specifics about, hey, I realize now that in my corporation, I can do active, I can do multifamily build, whatever it may be. If you guys want more about this, make sure you let me know, and then I can set up another call with some realtors that we work with that help and specialize in that area. But if you want to hear that, let me know and I can circle back.
Actually, Vishal, it might be good too if we loop in, if we do have another one, we actually inform everybody about active income on multiple rentals as well. You can structure that too. And we've done that for another client, me and you. We've done that together as well. We've actually complemented that with a couple of corporate class investments, and it's actually worked quite efficiently for that client. So,
Absolutely. Yeah, no, definitely. We have a lot of honest stories that we can share with you guys, which is great. And as we said, it's not one asset class over the other. It's a blend. And oftentimes when we structure it correctly, one solution will help you build the next solution as well. So we definitely will circle back to that. And if there's a lot of interest, we will set up a few different seminars to go specifically into different avenues there. So things to remember when investing through your company. Investing through your company can be quite complex. You need a team that has experience blending tax planning with investment growth. It's not one or the other. It's not a battle between the two. They really, really do complement each other. Ryan and myself have done. 2020 was crazy. It was one of the years. Thankfully, we're very fortunate that it provided a lot of opportunities, and we made sure that there was a lot of task questions, and people had a time to take a step back and look at their financial situation. So we've done a ton of these, and this really is, as I said earlier, our bread and butter. This is the space we give the most value. It's the space that we love and enjoy working in the most. Passive income versus active income. It really is much more beneficial for you to have active income, primarily in your corporation. So making sure you know the difference between those two and asking questions if you're not aware. And some of the most efficient options out there are corporate class investments, IRPs, IPPs, and active real estate. I put an asterisk beside IRP and IPP because we're going to have another session about that a little bit later. This year, we've moved a few $1 million into IPPs. It is a great way for you to potentially get a deduction on your business and pay even less tax, if it makes sense. Again, not everyone can qualify for these, so it is a really case by case situation. So I strongly recommend, if you have questions about these, again, my only sales pitch was give us a call. We are offering for anyone that goes through this webinar series a free financial snapshot review. Look at your taxes, look at your assets, and see if there's some opportunities to get better there. Small business owners, you guys are there's plenty of you, and you're all very, very similar. 97.9% of businesses in Canada are in small business, and much more of those are on the smaller side as opposed to the larger side. So a lot of you have very high profit margins and very, very similar situations when it comes to swollen up retained earnings and not knowing really what to do with it. But as I said earlier, there's always two sides of your finances. There's your corporate and your personal. So I'm going to briefly go through some examples of what you can do on the personal side, and then we'll close this out. So personally, it's anyone looking to invest their personal income for a property purchase, usually primary residence or maxing out your registered investments. And oftentimes with business owners and professionals like yourselves, it's not trying to hit home runs. It's just maximizing the tax efficiency of these. So generally, we look at conservative portfolios. Not going to hit a home run, but it's not going to hurt you. We use a company called CI Direct Invest. Extremely low fees. It's about 1% MER on these, and pretty good returns. 4.89 year to date since inception. It's done about 4.8 as well, and it's very well diversified: mortgages, bonds, equities, real estate as well. It's very transparent. You have an app, you can track this, and it's fully liquid, so you can pull out whenever you want to. And this is what we usually use for people less than 150,000. And we eventually move over to a investment of, if you have personal portfolio more than 150,000, great for people that used to work with an employer, have a LIRA or a locked-in registered account, and want to combine your assets and have it sit there, grow passively. We use Kai. This is about 13.3 average return, double digits to be safe. It's been very, very consistent, very strong, and a very well-respected portfolio out there in the marketplace. Again, it's also fully liquid, so if you need to liquidate, you can do so. They're diversified: 50% stocks, private equity, 15%, 20% real estate, and 15% bonds. Like we talked about critical illness earlier, oftentimes with our business clients, we can shave out some of those bonds and use a split dollar critical illness. It works really well tax-wise, but we'll circle back to that later. Um, and it's not a shotgun approach of stocks. It's very specific. So Amazon, for example, very sexy. Everyone loves Amazon. You see all these memes. If you invest in Amazon, you would have made this much money. But we chase return on investment. That's the most important number. So for you to get $1 profit with Amazon, you have to invest $41 with a 2.5% return. However, if you did that with Oracle for the same dollar profit, you're looking at about $13 of investment. So 7.6. So much higher yield, better investment, and better opportunities for growth. On the private sector, they own 7 medical clinics and 10 pharmacies in Manitoba and Alberta, 27 family physicians, 18 specialists, running 750,000 prescriptions a year to their 28 pharmacies. Very well run operation. The thing about us Canadians, we're getting older and sicker, so that portfolio is going to grow. I didn't mean that to be doom and gloom and bad, but yeah, we're getting older and sicker. And the real estate portfolio: 90 properties, 446 multifamily units, and over 200,000 in square feet of commercial space. So lots of returns on there as well. Question comes up: best strategy to invest. As I said, we've moved millions of dollars this year into corporate class and IPPs and things like that. Some of which, with the volatility of the election down in the States and COVID, some people ask about timing the market. The simple answer: can't time the market. It's impossible to time it perfectly. So dollar cost averaging sometimes is a good opportunity of how to invest that money. Oftentimes our clients will inject one large lump sum, and then they'll break it the remainder over 3 months, 4 months, 6 months. That's a great opportunity to sleep well at night, where you're not worried about, did I time it wrong or right. But it's not available if you're transferring your investment from a different institution. It's already in the market, so you might as well transfer all of it at once. As I said before, we're fully independent. So myself and Ryan, our biggest interest is making sure that you guys are happy, your guys' family is happy. And if you look at old money that's been in here in North America, it's because it's been transitioned from generation to generation. That's our goal, is to make sure that you, your dependents, your legacy, your charities, whatever you want to do, that we can get you there the most efficient way possible. Between us, we have about 50 5-star reviews on Facebook, Google, and we're very, very proud of that. And here's contact information. So phone number, email address. I'm located in Surrey, my office, but with COVID, we're doing everything virtually. So we can meet anyone, anytime. And my only sales pitch, as I said earlier, was that if you have any questions, feel free to contact us, myself and Ryan. And also, if you had to jump off, I'm going to be sending this to you. And I'm also going to link Ryan's info in here as well. If you were on this, we were offering a free review of your financial situation. So your corporate tax picture and everything in between. We can review that for you and give you a clear picture of kind of where you're at. That's it. That's it for me. Ryan, do you have any last thoughts?
No, I'm good on my side. I think we have a message in the chat from Adesh, and I think the question was basically do you work with our existing accountants to replace the services they offer? I think that was targeted for both me and Vishal. No, I think me and Vishal will, we'll offer pretty much a combined approach to your existing team. What we're looking at right now is providing a complimentary overview. So that's specifically just directed to each and every one of you here on the call. And then at that point, of course, if, for example, we don't want to step anybody's toes, your accountants have a great in-depth tax program, then obviously Vishal will work with them regardless of whether or not you're working with us. So.
Yeah, exactly. Our goal is, we've both built our practices off collaboration. So we can work whatever works the best for our clients. If it's a collaborative approach with the existing team, or becoming their team, whatever works the best. So, great question. And if there's any other questions, we are running short on time here, but if there's any questions, we'll circle back, and feel free to contact us directly. And Jobin, thank you very much. Appreciate the feedback, and we hope you guys got some good value out of this. Okay, guys, have a great day. Enjoy the sunny Saturday.